Equity or bonds?
Bosses have still not decided that I need to go.
No. दादाजी के जमाने से आ रहा है कि बेटा पैसा हो एफडी में बैंक में सेफ रख लो.
That is something that you should always refrain from doing.
How do you manage stress?
Breathe. 1% crowd in Bombay might have a higher allocation to equities.
We're shooting with the Mumbai rain just to bring you the local flavor. Buy a house, education, buy a car. Yeah.
Anything that is well defined, I think bonds serve that purpose very well.
And I see you on television often when these come out.
Thankfully, I don't do much of that, but this story is related to television only.
So you're saying if people want to learn financial investment, they should invest in bonds first.
Of course.
This content is for educational purposes only. The views expressed are personal and should not be considered as recommendations to buy or sell. Please consult your financial advisor before making any investment decisions.
Hi, and welcome to the next episode with India Bonds, where we try and demystify ये bonds क्या है, ये fixed income क्या है, and also decode and how it should be part of your portfolio. But you don't have to hear it from me. Today, we have a guest who has invested for 25 years in fixed income, a prominent figure in the mutual fund investment industry, the CIO of Nippon India Mutual Fund, Mr. Amit Tripathi. Amit, welcome to the show.
Thanks, Vishal. Thanks for having me today.
It's not usual that we talk about fixed income in forums like this, Amit. But before we get there, why don't we hear your story? How did you choose fixed income? What have you done in the past 25 to 30 years? Love to hear your story.
Okay, thanks, Vishal. Glad I'm here. In fact, this is a format that I've never tried in my life earlier.
Excellent.
So, this is the first time for me also. So, fixed income happened part by design and part by accident.
Okay.
Came to Bombay in 99, was working with New India Assurance. Started as a equity research analyst. Did a very mediocre job for the first 12 to 18 months, I should say. Actually, made some buy reports for some of the worst tech stories during that time.
Oh my God. So, जिसको equity नहीं आता वो fixed income में जाए से.
There were quite a few imperfections that one could generally see in the market. And because nobody else was interested, I got to get in because I wanted to get in. And that's where the journey started, and it has never stopped since.
I know it's 21 years at Nippon India Mutual Fund, right?
Yes, so 2003 till date.
How does one stay that long in a company? Amit, tell me about your journey, because you see the young people nowadays who are looking for changes every 2 to 3 years. But you're a stellar figure in fixed income industry in the country and at the same place.
I think people look out for options when the growth is not symbiotic. As in, if the company is doing too well and you are not doing too well, else you think that you are doing well, but possibly the environment or the growth in the company or of the company is not keeping pace with your own career aspirations. In hindsight, I could say, gods have been kind. I've been doing reasonably okay in the company for the past 21 years. Bosses have still not decided that I need to go.
No, of course, we don't decide that. You're doing an amazing. I'm sure you're doing an amazing job there. Now I just want to move on to the asset class, right? So people like you and me have spent 2 decades in doing fixed income.
Yes.
We love the industry. We love the benefits. In India, people are not very aware of that, right? So why do you think, because you have a diverse bunch of investors over 2 decades, why do you think there's a lack of awareness in bonds? And what are bonds? If you were to explain to your children, to a 10-year-old, what are bonds? So 2 questions really.
So bond is a simple contract, right?
Yes.
It's a contract between 2 people. One person borrows money from the other person, promises to repay it back at a certain point in time with a certain rate of interest. That's the simple definition of a bond.
Perfect.
I think there is a lot of historical background to why bonds might not have picked up in India, although I am not the pundit to kind of, give you yarn on this. But generally speaking, I think because we have been a predominantly banking-led lending model in India over the years.
Yes.
And banks have done all the heavy lifting when it comes to all types of lending in India, including retail, including wholesale, including creating infrastructure assets, including solving for working capital financing, including giving home loans, car loans, everything. So you think about any kind of lending that happens in this system, banks have been at the forefront. This is the journey of any market which is developing. So typically you will have a set of institutional lenders first come in, the infrastructure will get set up, the market will get set up, and then slowly as the market gathers more sophistication and more understanding, bonds which are but naturally a superior alternative to a normal loan as a product start taking over. And that's the transition that possibly India is also going through. So I am not surprised as to why bonds were not so popular earlier. So it's pretty, I would say, natural as we go ahead this path that bonds start becoming more and more mainstream. And I have no doubts in my mind that 10 years down the line, when I would have thankfully retired, you would not, and we would still be having that conversation. We would be at a very different place as far as the bond market story is.
No, absolutely, Amit. I've taken on a different journey, as you know, which is making bond in every hand, and I think this journey is going to be long. But taking off from that, you spoke about how in economies, equity and bond makes sense. A lot of our audience is mass investor in the country, right? So if we talk about there are 200 million almost demat accounts in the country, and as per an NSDL report, only 2.5% of those accounts have fixed income in that, right? So that's a very, very small proportion. But so can you tell our audience why investing in bonds or debt mutual funds, because you're championing Nippon India Mutual Fund, is important for a portfolio? Why should people do that? Why shouldn't I put all my money in equity? I've had phenomenal returns in the last 3 years. Why is it important?
So I think at the very base level, a bond defines the risk-return equation much better than any other asset that I have seen in my life.
Okay.
You have a very well-defined set of cash flows. You have a very well-defined set of deliverables. You have a finite time frame in which this happens. And you have very well-defined rules and regulations around that framework to say what happens if that does not happen. As in, if the bond does not deliver, then what are the consequences of that? So I think in that sense, as a financial saving instrument, I don't think there is any financial saving instrument that is as well defined as a bond. And I would rate that far superior to equities in that sense from an understanding perspective, right? And hence it should be logical or very, very intuitive for a person to actually first get into bonds before he gets into equities.
So you're saying if people want to learn financial investment, they should invest in bonds first,
Of course.
before equities.
Of course.
Can you elaborate?
Because that's the base of a contract. See, a basic transaction where one person gives money to the other person. In equity, we denote it as ownership of a business. In bonds, we are simply saying it's lending to a business. But ultimately, you are putting money into the business. Now, if these are two types of contracts, in one contract, you have much more well-defined rules and regulations, payoffs, risks and returns. Whereas in the other contract, the potentials could be at the margin higher if the business does well. But those potentials are not something that you can actually put on a pen and paper very easily at the point in time when you're investing. So it's a much simpler, much more logical, much more transparent maths for any investor when it comes to a bond versus an equity. So
If I get you correctly, what gives you comfort in bonds that it is defined as a financial risk? It has set parameters, unlike equity, which is about a growth of a company. So that's very exciting because that's really a bond versus equity comparison. And so you say that people should start investing with bonds first.
in fact, people do.
Yes.
It's just that in India, historically, people have traditionally been more fixed deposit investors.
Yes.
The moment you start thinking about it in that kind of a yardstick or that kind of a framework, a bond becomes very easy, right? In fact, banks also issue bonds, by the way.
Yes, absolutely.
All of us know, right? So it's exactly the similar contract to what an FD is. So everyone on the street would know what an FD is. So I don't see any logic why everyone on the street should not know what a bond is.
So which brings me to the next point, very interesting. This debate, FDs versus bonds, right? So fixed deposits in this country is reached across $2 trillion as such because our parents and grandparents, दादाजी के ज़माने से आ रहा है कि बेटा पैसा हो FD में बैंक में safe रख लो. So it's really like a savings instrument rather than an investment instrument.
Exactly.
But this debate is always on, Amit, as to bonds versus FDs.
Right.
So can you think what are the differences or benefits of one over the other?
So I think both of them have a place, first of all. FDs play a very big role in terms of the basic education for any person, as in,
Yes.
there's an opportunity cost when you part with your money, and that opportunity cost earns you an income. That concept remains the same across both.
Because your current and savings account gives you 2 to 3%.
Correct.
So you put your money in FD as a first principle.
Correct.
Okay.
Correct. But at the same time, like we said earlier, that ultimately a bond is an evolution. So, for example, if you lend money to a government of India or to government of India in a government of India bond, you get X rate of interest. If you lend to a very highly capitalized, highly rated corporate, you get Y typically higher than X. And the degree of compensation keeps on increasing in a very scientific manner as you go on taking more and more risk. Now, that is much more well defined in a bond as compared to an FD. Yes, you will have slight FD rates different in between various banks, but that differentiation more often than not is a function of balance sheets or requirements at that time or ALM at that time, rather than the credit worthiness aspect, which is so well defined in a bond. I think that is one basic difference. The second thing which makes bond far superior to an FD as a product is that you have multitudes of solutions in a bond, or I would say multitude of fair solutions in a bond as compared to an FD. So you have solutions starting from 1 day up to 30 years as far as bond markets are concerned, and now 50 years as far as bond markets are concerned. I don't think FDs give you that kind of a diversity of solutions.
No, absolutely. I think you use the word diverse because typically in an FD, you're still investing in the banking sector or handful of NBFCs. With the bond markets, you can actually have a diversified bond portfolio, investing in corporates, different sectors of the economy.
Correct.
So actually, truly diversification.
And if I can add one more point, Vishal, which we keep on talking because we also run asset management companies, we run mutual fund schemes, we run debt schemes. I think one big thing that people miss out is the cost of intermediation or the cost of disintermediation. In the sense, a bank is never an end borrower. A bank is borrowing to onward lend to somebody.
Got it.
Right? At the end of the day, if somebody is borrowing from you to lend to somebody else, he keeps a lot of cushioning in between to take care of his costs.
Yes.
Nothing right or wrong with that. The point is that there is an intermediation cost involved. And that intermediation cost, given the entire cost structure, can eat away a lot of returns that you would otherwise get by lending to that borrower directly.
No, absolutely. I get that.
And that is what completely gets taken away when you're investing in a bond. There is absolutely no intermediation cost in that sense.
No, absolutely.
You're going to lend.
So basically what Amit is saying is that if you give money to the bank is investing into a corporate. So you can actually take away that cost by directly investing into bonds. And again, a platform like IndiaBonds gives you retail that access to do that. But one more question around bond investment, Amit. Why is it important in a portfolio? Because we are an equity crazy country. I think the knowledge dissemination or the adaptation of investing in markets really accelerated in the last 5 years. But till today, people say equity, right? So if I have 100 rupees, how much should be in fixed income and why should there be an allocation to fixed income?
The first is the visibility part of it. I think bonds are very important in everyone's portfolio for the simple reason that when you are thinking of a series of payouts in future, whether from equity or for bond or from any other investment, how well defined are those series of future payouts? And as we discussed earlier, that bonds have a much better defined series of future payouts defined on day one when you are investing as compared to equity. So the degree of visibility is much better. The second is the risk return trade-offs, to my mind at least, are much better defined in bonds as compared to equities. You actually get what you see, kind of a structure works very well in bonds versus equities. Third, I think for any requirement that you have, which is defined or which can be defined in terms of a time period, bonds work best. For example, if you're planning something for a payout 3 years hence.
So like a life event. And
Any
buy a
line segment
house,
which is well defined.
education,
Yes.
buy a car. Yes.
Anything that is well defined, I think bonds serve that purpose very well. If you were to look at fixed income and equity as two asset classes and not bonds, because the problem is that a lot of people say that, I will invest in only equities, but tons of money would be lying in savings and current account
Yes.
at that point in time.
Yes.
Tons of money would be lying in fixed deposits at that point in time. And they're just not considering that part as part of fixed income.
But that actually is fixed income.
Which actually is fixed income. So you actually have to talk about fixed income versus equities rather than bonds versus equities. Bonds have to be the mainstay within the fixed income allocation is what we have to talk about more and more.
Absolutely.
And to that extent, I don't think anybody would have a ratio in excess of 60-40 best case or 70-30 in that sense. I would say 1% crowd in Bombay might have a higher allocation to equities. But otherwise, I don't think there is anybody who has a more.
No, talking about Mumbai, we are shooting with the Mumbai rain just to bring you the local flavor. But typically, you said 60, 40, 70, 30 is the global asset allocation, right? 60 in equities or 70 in equities. People also talk about this 30-70 rule, that if you're 30 years old, you should buy 30% in fixed income. If you're 70 years old, your portfolio should be 70% in fixed income. I know you're doing it at an institutional level, but is there any thought to that? Is that make sense or a guiding principle?
I don't think age is a guiding principle. I think need for annuities is a guiding principle.
Okay.
A lot of people till the time they are earning, for example, they would say that I am getting regular income through my salaries and that substitutes for my annuity requirement, so to say, month on month. But the moment you get closer to a situation where those annuity requirements have to be substituted from a salary to investments, that is when I think people logically would say that the bond portfolio has to be much larger component of your overall portfolio, because ultimately you need those annuities on a month-on-month basis in a very well-defined manner. And I think that's the logic for the 70-30.
No, absolutely. You need annuities. You can invest in bonds to match EMIs because, you can have monthly income and things like that.
Exactly.
So thank you for simplifying it with our, for our mass audience. But I want to use this time now to take your expertise about the overall bond market. You've been a dominant player, as I said, a leader in the industry. You are on a lot of committees, whether it's AMFI, whether it's RBI or SEBI. What is your perspective of the overall Indian bond market? It's a $2.7 trillion market now, obviously dominated a large part by government securities. About 2.05, 2.1 is either GSEC, SDL, T-bills, and the corporate bond market is growing. But how have you seen this market evolving in the last decade? And, any ideas on how you see going forward?
So I think 2 or 3 things that stand out. One is that the bond markets over a period of time have now started playing a much more critical role in some of the crucial building blocks of the economy as compared to what they were doing earlier. The second thing that we are also noticing is that the market has started becoming more and more diverse. The government continues to be the largest borrower, but at the margin, I could say that in terms of the overall picture, when you look at the bond markets is now much more dynamic than purely government bond markets, which that is with the case earlier. A lot of development has happened there. A lot of innovation also has happened there. Last, I would say, I think one thing that one notices about the bond markets much more nowadays is participation is also getting much wider. Not only has the institutional participation got more wider, you have had a complete new breed of investors coming in, for example, pension funds. You have got family offices now coming in. But we have also seen retail, for example, now starting to get interested in bonds.
No, absolutely. I think traditionally, insurance companies, pension funds, bank treasuries were the largest investors in fixed income. And you're absolutely right. Family office, AIFs in the private credit segment. You obviously touched on my favorite topic, which is about retail participating. How are you seeing that, with this online bond platforms coming in under the SEBI regulation framework? For example, on our platform, we see rapid adaptation, but how do you perceive that running a debt mutual fund? As you said, are there more conversations being held? Do you think it's good for the bond market in the long run?
Yeah, I would definitely say so. In fact, mutual fund as a product actually offers that access to retail investors as such, and it has traditionally been the most well defined, or I would say very, very transparent kind of a platform to do that. Bond platforms are also now stepping in and serving the same purpose of bringing in retail investors into the bond markets and giving them the benefits of investing in bonds. I would rather have an investor who is investing only in mutual funds or only in bond platforms because he is adding to the ecosystem, adding to the conversation, adding to the participation, adding to the dynamism of the markets, adding to liquidity of the markets, adding to price discovery in the markets, rather than not having their.
No, absolutely. So this is not, like in equity, direct equity and equity mutual funds coexist.
Correct.
This is not an either-or choice of debt mutual fund or direct bonds. The whole idea is that as long as people are investing in fixed income, get the benefits of that, that's fantastic. Now, we'll probably come to the mutual fund industry, right? So how have you seen that grown? I mean, it's legendary how mutual funds, Mutual Fund Sahi Hai campaign actually taught about financial investments to the country over the last decade or 2 decades. I did see an ad on mutual funds, mein fixed income wali baat, but it's quickly got aired off. But why don't we talk about mutual fund industry? How has your experience, because you are on the road talking to your investors, institutional to retail, some anecdotes or stories from there, how's that journey been and how do you see it going forward in the industry?
The level of awareness and understanding has improved significantly in the last 10-15 years, I should say that. Investors are more exposed now than what they were earlier. So to that, I would think I would also thank you guys, for example, for having populated this space. They understand what is the importance of having a 25-year bond, government bond in their portfolios, for example, which was an understanding that it would have been very, very difficult conversation 10 years back. It's not a difficult conversation today. The only thing that is still missing possibly is the breadth of participation.
Yes.
Interesting episodes. I can't recollect interesting episodes with investors, but I'll just give you a small snippet of what I just remember. So you have these RBI policies that keep on coming every 2 months, right? Where RBI decides the level of interest rates, and there are a lot of announcements that happen.
Yes.
Repo rate, CRR, and things like that.
And I see you on television often when these come out.
Thankfully, I don't do much of that, but this story is related to television only.
Okay.
And something very funny happened once, and it's like the tickers that come on the screen. The tickers we all know come with some lag, right? Like equities, the fixed income tickers also come. I think very few. They should increase it honestly.
No, I've tried that conversation. Television, they're not willing to listen.
Yeah, but the 10-year bond yield at least comes.
Yes.
And immediately after policy, there was a conversation happening on TV, and the conversation was related to how did the markets react to this event. And because we were sitting in front of screens in our dealing room, we could see that the market was actually reacting positively, as in the prices were going up, the yields were coming down. But because the ticker was delayed, the ticker was actually showing a yield which was higher than the previous ticker. And there was a very, very funny confusion that got created in the studios with regards to whether the market has taken it well or not. So instead of looking at the screen, somebody was looking at the ticker and saying that, this is a good policy or a bad policy from a market standpoint. So these are some things that, people don't realize, for example, that like equity markets, like when you see the index levels, every second you keep on seeing the index level changing, or every 30 seconds you keep on see it changing. People don't realize that bond markets also have that kind of a dynamism.
Yep.
So actually, if you go and look at a government security screen or a swap screen, you will actually notice how fast prices change, how much participation is there.
We have people saying yesterday was the price, so why isn't here today, right? Because that these are markets and not door numbers, and they change, and bonds change as well.
Yes.
But I mean, just bringing to that point, the volatility that I see in the government bond market in India is so much more less than even if you're trading US Treasuries.
Yes,
right?
of course.
So in a way, we are in a much more strong position.
Yes.
Is it a bond market which is very deep? Why do you think, as an emerging market or developing to a developed market country, why is the volatility so low? Which is great for investment because we like low volatility.
Correct.
Any ideas why is the case?
So first things, I think it is great for investors. 97% of the markets in India is still domestically held. Unlike equity markets where you have reasonably higher participation from foreign investors, Indian bond markets are just opening up. Second is the fact that a lot of players who participate have very well-defined reasons for participation, whether it's insurance, whether it's pension. I'm talking about the dominant players who actually make the larger volumes in this market. Even banks, for example, a lot of them are driven by statutory requirements of investing in bonds. So I think the structure of the markets is also something that impacts the inherent volatility in the market. You have been part of this ecosystem, Vishal, for too long. You know that India is one of the most stable markets in Asia.
Absolutely.
Even in periods of macro crisis, Indian bond markets have actually given reasonable exits to investors, which very few other markets generally give. So I think that's a big plus point as far as Indian markets are concerned.
So comparing India to other international markets, Amit, your parent company is a Japanese company.
Yes.
Right? And I'm sure you've been to a lot of international events talking about the India story. How is the Indian bond market looked from international perspective? Not necessarily Japanese, but just, how people sitting outside, obviously the bond index inclusions of JP Morgan, FTSE, Bloomberg played a massive role in putting the spotlight on the Indian bond market.
Yes.
Some benefit also because of the emerging markets, things happening in Russia, China, money had to get diverted. Maybe we saw the positive benefit of that. But some experiences in your international travels, talking to your parent companies, how is India perceived?
So I was recently in a short road trip, so I can relate very well to what you're asking, Vishal. And I can tell you that, possibly as much awareness we need to create in the retail fraternity here about bonds, we need much more to be done in the international community as far as India macro and India bonds are concerned.
Okay.
The problem is that while possibly when you think about Asia, ex-Japan, China and India are the only markets which you can actually look at as a country risk. All other markets are too small.
Yeah, and the size. You can deploy the size of investment.
The size, right?
Yes.
But if you look at it from the lens with which most international investors still look at India, they still look at it in the prism of an emerging market.
Yes.
So one of the very interesting conversations that we had recently, for example, India today is a 7% yielding market when it comes to government bonds. It's typical ballpark number. If I were to give you, it would be 7%. There are markets which are giving you 4-5% higher than what India is giving you within emerging market space. There are markets which are giving 4-5% lower than what India is giving you within emerging market space. So emerging market bonds give you everything from 2% to 12% as we speak. And I'm talking about reasonable sized markets, right? The interesting conversation that we had was that when you actually place India at 7%, with the volatility that India gives vis-a-vis other markets,
So volatility adjusted.
the volatility adjusted returns of India are significantly superior to any other large emerging market that you can think about. And this comes out in terms of data, not for the last 1 year or 2 years, but for the last 10 years. Believe me, this has been a revelation for each institutional investor that I spoke to when I was on my road trip. So it is not that, the numbers are not good or India is not a great story. In fact, we need to tell that India story from a fixed income perspective much more than what we generally do. It is by definition that India is a high growth economy. So everyone gets attracted to India as a growth story, right? But India as a macro stability story is something that needs to be told much more than what has been told. See, after 2013, all the difficult reforms, all the difficult balance sheet adjustments, starting from the government to private corporates to financial institutions to NBFCs to everyone you think about.
And the whole Indian bankruptcy code,
The whole Indian
2016,
bankruptcy code,
which
yes.
is transformational.
Exactly. So everything has been done. The hard work has been done. We are there to reap the benefits right now. But somehow we don't talk more about it. So I think we should, at an institutional level, talk much more and more about this macro stability story as much as we talk about the growth story as India is concerned.
No, absolutely. I mean, that's that has been the case. Absolutely. One question for you. You said a lot of development has happened in the last 10 years.
Yes.
There's always desire that more can happen.
Yes, sir.
If you were to pinpoint for 2 or 3 main structural issues, which would promote the Indian bond market internationally and also help our retail to invest more because we need new investors for the growth of the market, what would be, at the top of your mind, what 2 or 3 key things need to be done for promotion of the bond market in India?
So I think a corollary to the wider participation is essential liquidity, right?
Yes.
I would believe, given the size of the market, especially when you go outside the government bond markets, we could do with much more secondary market liquidity than what we have now. You have now a RFQ system in place, right?
Yes, RFQ.
You have a screen-based market for corporate bonds in place. You need to have some kind of a symbiotic co-presence of a screen-based dealing market along with a screen-based repo market. The moment you bring that liquidity into bonds, and I'm sure you know this much more than I do, believe me, the volumes are going to just be very, very different than what we are seeing today. There are a lot of things that can be done around settlements, for example, access to bonds, for example.
Yes.
But I guess the starting block to my mind would be to address secondary market liquidity.
No, absolutely. So I think, Amit, what you're saying is that for any market to grow, liquidity is important. I think repo is one side, you said. Obviously, access to bond markets is something what people like us at IndiaBonds, online bond platforms are trying to get that, because the more the market participants, I think liquidity will be there. Very interestingly, you touched upon RFQ platform. And, that is in line with how international bond markets are. And maybe, one of the thoughts that we've always had, that corporate bonds are the only asset class which is traded on 3 different venues on the exchange. So there's an RFQ segment, there's a capital market segment, just a little bit of jargon. You know this, OTC. But we always think that if you can combine the symbiotic relationship into one platform, that can get a lot of liquidity. So Amit, we've had a lot of conversation about the structure of the fixed income market, mutual funds. I want to get to know you better, right?
Oh.
So you've been an asset manager, a prominent fund manager for many years. How do you manage stress?
Breathe. There is no substitute for want of a better word, good quality Delhi language when you are in stress.
Okay.
But apart from that, I guess it's breathe. But I guess I would take this opportunity to speak for our families.
Mm-hmm.
Your family, my family, or everybody's family who has been part of the markets for long.
Mm-hmm.
I guess at some level, stress shows up in how we behave and react. Because every time you're not going to, spell out that I had a bad day in office, you're not going to say that I have this problem. Typically, it comes out in terms of your mannerisms.
Mm-hmm.
And I would give a lot of credit to families for coping us with us at that point in time.
No, absolutely. Very, very nice, humane, effects of how to manage stress. For India is full of these young traders who've come up, right? So people who are doing it on their own, in various institutions, in funds, etc. Any top 2 advice, investment advice for a long-term career? Because you can be a very good trader for 1 year, 3 years, but to do decade in and out, I think that needs certain amount of tenacity and resilience.
Correct.
Any 2 character attributes you think people should try and develop as they develop a long-term career in financial investment?
First and foremost is discipline. I don't think anything substitutes discipline in any career, including a financial services career, especially when you are in any kind of a high stress kind of an environment. Discipline is very, very important. And second is applying yourselves. I think, Vishal, when all of us enter this market, we enter this market with differentiated credentials. But what we do in this market when we stay for 10, 15, 20, 25 years is completely the tenacity and the application of how we apply ourselves day in and day out in this ecosystem, in this market. No substitute for hard work. I think it is very important for people to understand, do not get into something which you don't understand. Things look very attractive, especially when you don't understand. And that is something that you should always refrain from doing. So only 2 things, discipline and get in after you have got an understanding. Try to get in. You should not also walk away saying that I don't understand, so I will not do it. Try to understand and do it, because there is always a payback for the effort that you put in. So you need to put in that effort, get that payback.
But understand with a small potential damage, right? So
Yes.
to learn financial markets, there might be times that you'll have to, not necessarily make money, but you have to stay at it in the discipline of it.
Yes.
Next section, Amit, is what I call the rapid fire round, in which the first thing that comes to your mind across asset classes. Real estate, buy or rent?
Buy one
Okay.
to stay.
Buy one to stay. Bitcoin, what is it?
I would not avoid it. I would understand how to use it.
Okay. One book on financial investment that you would recommend everyone should read?
The book that I'm currently reading or rereading is The Hungry Tide. One book that would come to my mind in terms of understanding asset classes possibly. I found The Price to be a good book if you want to understand the history of oil. So The Price by Daniel Yagin is a book that I found interesting.
Equity or bonds?
Both.
If you were not a fund manager, what would you be?
A teacher, and if I didn't get that job as well, then possibly a member of a band.
A member of a band, music band. That's amazing. I thank you for watching this. We've come to the end of a fantastic session with Amit Tripathi, CIO Fixed Income for Nippon India Mutual Fund. It's not very usual that the great CIOs of fixed income in this country come on camera. So we're very thankful for you to be here and talk to our audience. And we look forward to engaging with you lots more in future.
Thanks a lot. Thanks a lot, Vishal. Thanks for having me here, and best of luck with the good work that you and your team are doing.
Thanks a lot, Amit. Thank you.
Investments in debt securities, municipal debt securities, securitized debt instruments are subject to risks including delay and/or default in payment. Read all the offer-related documents carefully.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.